Thank you for joining. So tonight we are going to talk a little bit about income investing. So we have done a series of webinars over the course of March where we have talked about income investing. This is a little bit of a summary. We do have those other videos available on YouTube. So before we get started, we do have to go through and of course go through our general advice warning. So anything you do here today is general advice. I don't know anything about you, so I obviously cannot offer personal advice. But we would like questions. I would like questions. It makes it more interesting if you have a question. Somebody else probably has it as well. So you can send through any questions you have in the Q&A or the chat. If you have any questions about what we have, or if you can't find the videos that we've done earlier this month on income investing, I'll refer to a couple of them as we go through. Just send me an email. It's on your meeting invite. So it's just mark.lamonica1@morningstar.com. So you can send through any of those questions. But anyway, let's get started. Talk a little bit about income investing. Obviously a pretty popular topic with investors. So why don't we start off by talking about what it is? What is an income investing strategy? And really, there are two different sides to this. So what's probably the more traditional income investing strategy is, of course, the goal of creating a reliable and growing income stream, and particularly a passive income stream. So, of course, passive income refers to anything you don't have to work for, which is all very nice. And so that's very attractive to a lot of people to generate income off of interest and dividends and everything else from their portfolio. And a lot of people, the goal that eventually their portfolio can actually do the work for them, which is a great concept. But another part of an income investing strategy is for people that maybe aren't necessarily concentrating specifically on generating that passive income stream, but really is part of a factor-based strategy. So when we talk about factor-based strategies with investing, what we're trying to look for are the factors with particular investments that will drive certain outcomes. And really what a lot of people are looking for from an income investing strategy and that income investing factor is they're looking for higher returns, so that this is a way that you can actually outperform the market, and looking for lower volatility, so a portfolio that bounces around less in price, and that downside protection. So particularly times when we have market stress and the market is falling, that an income portfolio will fall less than the market. So we'll talk a little bit more about that second strategy, but one very important thing to take note of is the fact that obviously these two work in conjunction. So you don't have to pick one or the other if you're looking for an investment strategy. It's just really pointing out that a lot of people are using income, not just for that income, but also because they're trying to achieve other outcomes. So let's talk about that second one for a second, just to set the scene. So I took a couple charts, and sorry for the very busy slide. I took a couple charts that I had on different slides over the course of the month. We can talk about why people are looking for this as more of a factor-based strategy. So the first thing, starting up here, dividends contribution to total returns. Now, this is titled varies by decade, but it's very important to sit there and look at dividends do play a large part in the overall returns you're going to get. So this is looking at the US market. I'll talk about the Aussie market in a second, but you can see over the course of different decades that the contribution from dividends has swung. And a lot of that's really based on sort of what during those decades, what was the investing climate, what were the types of shares that performed well during those decades. But you can see overall from 1930 on, 40% of returns came from dividends. Now let's sort of turn our attention to Australia. So Australia, as people that have joined these series before should be aware, Australia, number one, has higher yields. So meaning that you are typically getting more dividend income per dollar that you invest in Australia than you're getting pretty much anywhere around the world. And a lot of that is because payout rates are higher. We'll talk about payout rates a little bit going through this tonight, but a payout rate simply refers to how much of the earnings are being paid out in dividends. So high payout rates mean that potentially the majority of earnings are being paid out as dividends. So Australia, of course, has a higher payout rate. One of the reasons Australia has a higher payout rate is, of course, because of franking credits, because franking credits make dividend investing even more attractive for Australians in Australian companies, and companies have responded to that by paying out more of their earnings as dividends. So this contribution from dividends is actually higher in Australia. So one that just kind of stresses the importance overall of dividends. So then what we can do is we can move over and look at performance. We've got two different charts that are talking about performance. So basically this first chart over here, second quintile stocks outperform most often from 1930 to 1921. So what this is looking at, it is looking at dividend payers, so shares that pay dividends, and then is dividing that universe up into quintiles. So basically dividing that by 5 from highest dividend yields, which are represented by this first quintile, to lowest of the dividend paying dividend yields. And what these percentages are on top is it's looking at if the dividend paying shares in that quintile, once again, looking at the S&P 500, outperform the overall index. So as I said, the way that we think about dividend investing and the way that it's often portrayed and characterized in the market is that you are making a choice, that you are deciding that you will either invest in shares that pay dividends, or conversely, you are trying to go for those high growth companies that do not pay dividends, and that's where you're going to get higher returns. But what we can see from this is that's not actually true. We'll talk a little bit about why this is, but you can see the percentage outperformance in each one of these quintiles, all except for this fourth quintile, interestingly enough, have outperformed the overall market. Now, in this case, I guess we're just meeting the market, right? Because only 50% outperform. But taking them in the aggregate, most of them have outperformed the market. Now, why is that? Well, we have this misnomer that companies, obviously, that don't pay dividends are also growing very quickly. But it's also important to think about the characteristics of dividend-paying shares. So in general, companies that pay dividends are more mature, they are larger, they've been around longer, they're in better financial shape, they earn money. So a lot of companies don't actually earn money. So all of those traits really lend themselves to paying dividends. And what those traits also really represent, which we'll talk about in a second, they also represent lower business risk. Because if you're a very mature company, if you're in good financial shape, if you've been around for a while, if you're bigger, your business risk is generally a little bit lower. And that business risk is looking at what's the risk this company could blow up and go out of business, or there could be very, very bad outcomes. And so business risk is important to take into account. So while you may get some home runs going for these very fast growing companies, or I guess to use more of a Aussie sporting analogy, you may get some sixes, but you're also going to get out a lot. So this really shows that it's not a trade-off. It's not necessarily a trade-off between having an income investing strategy and investing in growth and earning outsized returns. So something important to think about. Another return-related chart, which for anyone who was on earlier today, I went through during that presentation, so apologies, is it's looking at the types of dividend payers. Because both of these charts do have another insight that we can use when we're investing in dividends. So basically, very quickly, what they've divided here is they divided the universe of overall shares. So once again, looking at the S&P 500, shares that between this period, 1973 and 2021, shares that grew dividends or started dividends, overall companies that paid dividends, and you can tell these lists are overlapping in some cases. Companies that did not grow their dividends, so there's no change in their dividend policy. Companies that did not pay dividend, companies that cut or eliminated dividends. And what you can see is, particularly if you can find companies that are earning or that are growing their dividends, and even just dividend payers in general, you're outperforming the market. So you can see that return differential there. And if you go up and look at this chart again, you can see that the highest dividend shares, this first quintile, right here. So those are the 20% of highest paying dividend shares. They actually perform worse than the second quintile. And so it's an important thing to think about, that outperformance is correlated with the ability to grow a dividend. Now, obviously, being able to grow your dividend, which we'll talk about a little bit later, is a sign that you are doing good things as a company, that you are actually growing as a company. And that allows you to continue to raise that dividend. But sort of the focus here is don't chase yield necessarily. There are other factors that you need to go in there and analyze before you're making an investment, but just purely chasing yield, companies that may have very high payout rates, maybe they don't have anything else to do with their money, they can't invest, they can't grow their business. It's not necessarily the place you want to land. It's potentially looking for those companies that are able to still grow their dividends. So something to think about, because we all kind of reflexively just go after high yield. We think, okay, if I'm trying to invest for income, I'll just buy the shares that pay the highest income. But just remember, potentially you have a very long time horizon. So what you're really looking for there is growth. And there's a trade-off between high current yields and growth. The other thing that's really interesting about this chart, at least to me, is if we look over at this standard deviation measure, and we can look at beta as well, they're both measures of volatility. So standard deviation, without going into it too much technically, looks at the dispersion of returns versus the average return, right? So if the average return is 5% and the return on the security is 5% every single year, you have no dispersion. But if you have a higher standard deviation, it means it's bouncing around more in price. You could have a very good year, you could have a very poor year. And those are very wide apart in terms of where that average is. So we want lower standard deviations. That equals lower volatility. So what you'll see here is, interestingly enough, dividend payers and dividend growers and initiators actually have less volatility than if we look at the overall market, or certainly if we look at some of the other categories. And as I said this afternoon, this is really something that is supposed to happen in investing. So what is supposed to happen in investing is the more risk you take on, as defined by volatility, the higher returns you should have over time. But this is showing an actually perfect scenario as an investor where you're getting higher returns. Look at this, dividend growers and initiators, and lower standard deviation, higher returns with less risk. And this is another reason people are really interested in investing in companies that pay dividends, because, of course, there's lower volatility. And lowering the volatility of your portfolio is something that a lot of investors are very interested in, particularly in certain stages of life, like the transition to retirement. So another reason why dividends are popular, why people look at that as a factor in trying to get an outcome out of their portfolio that they want. So something important to look at here. And when we talk about lower volatility, what's implied in that as well is downside protection. So downside protection meaning when there are falling markets, you don't just want to have lower volatility when the market's going up, right? You're really looking for that when the market's going down. Do you get downside protection? So once again, we're looking at the US. This time we're looking at the S&P 1500. So the S&P 500 is the 500 biggest companies in the US. 1500, of course, is the 1500 biggest companies in the US. And we've got three different categories here. We've got the high yield dividend aristocrats index. We've got the high dividend index, and then we've got the composite. So basically the overall return from the portfolio. Now there's a difference between what's considered a dividend aristocrat and what is in the high dividend index. Dividend aristocrats are companies that have grown their dividends, I believe, for 25 straight years. So that's where you're really getting that growth that we've been talking about, what you're looking for. Whereas the high dividend index are just the highest yielding shares. So those are, obviously the shares that are paying the highest dividend in the index. So what we see here is in down months, so months where the market went down, we're seeing you are getting that protection from both. You're getting the protection from these high dividend aristocrats, the ones that are growing their dividend, and you're getting them from high. They've gone down less than the overall market. But then if we look at the 15 worst months, so this is looking at 1999 to 2022, the 15 worst months, really only getting that protection once again, from these aristocrats, companies that are continually growing your dividend. So can't stress it enough. Explore that trade-off between yield and growth, because growth is pretty important. It's pretty important if you're trying to grow your overall dividend stream, which we'll talk about later, but also very important to get these other factors you may be looking for. So whether that is outsized returns, downside protection, and very simply the theory behind why dividend paying companies, and particularly companies that are growing their dividend, do better and offer that downside protection are the same attributes I talked about before. They're bigger, they're more mature, they're in better financial shape, all the stuff that you would really want during trying market times. But also there's just an intuitive reason for somebody to hang on to these shares. And that's simply because you are still getting something out of it. Right? You are still getting that dividend payment. You're still getting that income stream. Whereas if you're investing in a share that doesn't and the market's plummeting, there are more reasons that people can rationalize selling those. So something we can see there. All right. So let's move on to one last reason why investing as a factor and looking at dividends is something that is valuable. And really what we're talking about here is, can you use a dividend yield as a way to value a company? Now, a dividend is not necessarily representative of the value of that company, of course, because what you're really looking at is future earnings and the earnings potential that's generated by a company. But a couple things to consider around that. Number one, earnings can be very volatile, especially over short time periods. And so you can see, one, with just the cyclicality of the economy, you can see earnings go up and down and bounce around a lot. And that's going to impact those traditional measures that we use to do a relative valuation of a company or an overall index. So that's when we sit there and look at a price to earnings ratio, for example, price to cash flow, et cetera. Well, dividends bounce around a lot less. So dividends may, in fact, be an opportunity, particularly during times of economic turmoil, where you can really look at a share and see if it's valued. So what I did on here is I went back from the year 2000 to the year 2000, up through the year 2021. I looked at the S&P 500 earnings, the year-to-year change in the growth of earnings. So that's the overall index, all the companies that make up the index. Then I looked at the S&P 500 dividends and the year-on-year change. So it should be very obvious looking at some of these numbers that these are much more steady if we go over and look at those growth rates for dividends. And remember, we did talk about standard deviation. You can see the earnings standard deviation, the dispersion around the average earnings growth is very, very high. That means that 62.15% means it's bouncing around a lot. Earnings are bouncing around a lot. And of course, as earnings bounce around, it throws off all those things like a PE ratio that people like to use, a price to earnings ratio. When we look at the standard deviation of dividends, it's much lower. So there's an opportunity also to sit there on a relative basis and use the dividend yield of a certain share as a way to compare it to historic numbers and see how it's priced. So, right, something is trading for a lot higher yield. Potentially that means it's cheap. Now, there's some caveats. If the yield's too high, maybe you are going to end up chasing a high yield, maybe get into a yield trap there where that dividend disappears, but something to consider as well. So these are all of the factors that investors can use dividends for in order to construct a portfolio, even if your underlying goal is not necessarily the income kicked out. So it's just an opportunity to find those shares that will help your portfolio and help you build a portfolio that's going to do some other good things for you based on your personal circumstance. And of course, that is lower volatility, downside risk, protect you in downturns, and hopefully earn you a higher return. All right, so we've got a couple of questions on here. So I'll quickly go through a couple of questions and we'll keep moving. So Lisa says, as time goes by, do dividends increase in line with inflation's effect on stock prices? So it's a really good question, Lisa, and yeah, a really good point. So if you go and you look at these year-on-year changes, and I don't have the average right in front of you, these massively outperformed inflation. Now, remember, this was a lower inflationary environment. But what we have to understand is companies, of course, and one of the benefits of investing in shares versus bonds, where that income stream is set. One of the advantages of investing in shares is that you are going to have the ability, as a company has the ability to pass on price increases. So dividends should be a better opportunity for companies to pass on the impact of inflation. So they will have more inflation protection just by the fact that they move rather than fixed income. The only caveat I would add to that is that if inflation gets out of control and continues to last a long time, we can have very poor economic environments. It's the reason central banks are so focused on getting inflation under control, even if it causes short-term economic distress. That can have a real impact on the economy, a real impact on consumer behavior, real impact on saving and investing. And so we can run into those problems where if inflation does get out of control and craters the economy, then you are going to start to have some problems with dividends like everything else, right? A shrinking economy is not good for companies. It's not good for dividends in the aggregate. So that's the only thing that I would add. Okay, so we've got another question saying, but dividend yield is high, even if it dropped from 10% to 6%. Isn't that better than another company starting to pay a dividend at 4%? Not necessarily. And here's why. The question is, what are you trying to do by building this income stream? So a lot of people, and this is where your personal circumstances come into play, and it really does matter where you are. A lot of people, of course, will sit there and say, oh, well, higher yield is better. And then the next question I would follow up with is, okay, so why are you doing this? Why are you investing in an income stream? Well, I want to build an income stream because I want to retire in 20 years and I want it to help pay for my life. Well, what really matters to you then is not the amount of income you're making right now, it's the amount that you're making in 20 years. And there is, of course, a growth rate in dividends. If you can find a company that's growing a dividend and has the ability that you believe has the ability to grow their dividend significantly in the future, you can identify those companies. You might end up with more money in 20 years. And it's math at the end of the day. And, I do have a spreadsheet that you can go in there. If anyone wants it, email me. You can go in there and put in hypothetical growth rates and the yields of those securities and see where that actually is going to surpass. The growth is actually going to surpass more current yield. So it depends what you're doing. The other scenario is maybe if you are older and you think perhaps you have a very short time period, then maybe that yield matters to you more, that current yield. But yeah, I would say it's very dependent on sort of where you are from an investing standpoint. So Lisa says, if yield and dividend returns vary over time, is it therefore more important to hold a good stock for a longer time? I would say it's always better to hold a good stock over time. So you get a lot of benefits out of long-term holding periods. So, it's one of the, I went on this podcast the other day and I got asked this question about, what's something on finance or about finance that nobody ever thinks about. And, it's this notion of long-term investing, right? Everyone always talks about it. But really what we've seen is that holding periods have decreased significantly over time. I believe something like in the 50s, it was 6 years for the average share. It's now down to 5 months. So people talk a big game, both professional investors and individual investors, about long-term holding periods, but then they don't actually do it. So it's always beneficial if you can find a good share, Lisa, to hold it for the long term. Because what that's going to do for you is it's going to minimize your taxes, it's going to minimize your transaction costs, and it's going to let those dividends compound over time, as well as letting, of course, the share price appreciation compound over time. So yeah, that is important. So we have a follow-up question around the 10%, 6%, 4% question about yield versus growth, saying I'm 65 and retire soon. And I don't have a crystal ball, bird in hand. Yeah, I mean, listen, certainly maybe in your own situation, that is a better thing. But just remember, even at 65, depending upon what you're trying to do with your portfolio, you could still have a really long time horizon. So it's just be mindful of that trade-off. And I think be mindful, and we'll talk about this when we talk about diversification, be mindful of that trade-off when you're building an actual portfolio. All right, so I've got a couple more questions, but I'm going to move ahead a little bit, but I will answer all of them. All right, so how do you execute an income investing strategy? Well, very simply, there's a number of steps. But very simply, the first thing to do if you're executing any strategy is to have a goal. So we talk a lot about goals at Morningstar. It's no different if you're trying to invest for income. So in that case, what your goal would be is to either generate a certain level of income, if that's what you're trying to do, at a certain date in the future, or your goal would be to minimize volatility in your portfolio, to outperform the market. Whatever your goal is, set your goal, but translate that goal into where you want to be. So if you're trying to outperform the market, then your goal is going to be a certain amount of money at a certain point. We want to figure out that rate of return. If we're trying to generate an income strategy, be very specific. I want to generate $20,000 a year in dividends in the next 20 years, because without mapping out that goal, then we, of course, don't know what we need to achieve that. We don't know how much we need to save and invest. We don't know what the growth rate is, either on income or overall portfolio will be. So it's really, really critical to map out that goal so you actually know where you're going. Sustainability. So we saw on that chart, I'll go back to it if I can figure out how to work my computer. I'll go back to it. What is the worst place to be on this chart? Dividend cutters and eliminators. Not only was the return negative and significantly below that market return, the volatility was much higher. So that's the worst of all possible worlds as an investor, that you have a lot of volatility and you have very low returns. So we don't want to be that person. That's why the first focus needs to be on sustainability. And what I would say is one of the problems that we get into as income investors is, as I said, we kind of take this mental shortcut where we're just going to automatically find the companies that pay the highest yields and invest in them. And think that that's what we do. We want income, they pay more income. But remember, a dividend, of course, is not a requirement. It's not a contract. The company chooses to do that. And remember, a dividend yield is related to price. Right? So even if you're paying the same dividend, the price falls significantly, that yield's going to go up. And the share price might have fallen for a reason. That's why you still need to do your research. Share price might have fallen because investors expect the company to cut their dividend, or they see other problems in the company's future. So that's why we need to be very careful about chasing yield, because it really does no good if you go out there and find this 10% yielding share where you never get any of that, because that yield is based on dividends that were paid in the past. You care about the future. So the first step, before we even focus on growth, the first step is making sure that that dividend is sustainable. And we'll get into some ways to do that in a second. As I said, growth, not just yield. So it's important to not just focus on growth and yield. And what we want to do is when we diversify, moving on to that next step, we want to diversify also looking at those types of companies. There's no reason that you can't have, and I would, in fact, what I do. I have some companies that pay very high yields where maybe there isn't going to be that much growth. And then there's companies that potentially pay low yield, but I think there's going to be a lot of growth. So remember, you can have that mix in your portfolio. The other thing, of course, we want to diversify across sector. So companies that are selling different goods and services. And the reason we want to do that is the same reason we want to diversify our portfolio overall. We want to make sure that there is not a sector-specific problem that impacts those companies. It's going to impact our overall dividend stream. We want to spread those bets out. We want to look at geography. These two are very related, which we'll get into. But we want to do that because if there is a localized economic problem, we don't want that to sink our portfolio. So we want to look at where companies are actually sourcing revenue from. geographically. And as I said, style. So really looking at, hey, is this more of a growth share with hopefully a growth dividend as well versus maybe a value share that pays a higher yield? We'll get into the specifics around that, but I've been talking a lot about shares, but yeah, we want to be agnostic about the instruments we use, but we want to be aware of the differences. So where you go out and source those dividends or source that income, whether that's bonds, whether that's shares, whether it's in a collective investment vehicle like a fund or an ETF or a LIC or a hybrid, we want to go out there and we want to figure out, okay, we are agnostic to where we get that income from, but we want to understand what are some of the pitfalls and opportunities from investing in each one of those. Okay, so we'll go through a couple of these in detail. Start with sustainability of dividends. So as I said, very, very important. You don't want to go buy something and then have the dividend cut. That doesn't do you any good as an income investor, and frankly, doesn't do you any good as any investor, because that will likely have a very negative impact on the share price. So there's a couple of different things that we can look at here to assess sustainability. First thing is that you are still buying a company. So being overly focused on the dividend, even if that is your goal, isn't great. We need to look at the business. We need to look at the business that needs to earn those profits and generate those dividends. And we had the question from Lisa earlier about an inflationary environment. Well, an inflationary environment is very challenging, but just like any environment, who's going to perform well from a company perspective? Companies that have a sustainable economic advantage or a moat. So that simply means they're able to hold competitors at bay, that they will have improved pricing power, that they'll have improved margins, and they'll have improved capital returns when they're investing new money into their business. So the Morningstar Economic Moat Rating is a good place to start. Identifying companies on your own is a good place to start that have those sustainable competitive advantages, but you can use our moat rating. So if a company does have a moat, it means our analysts believe they are able to withstand that competition, which will lead to better outcomes for the company and better outcomes for you as a dividend investor, particularly that if there are factors like inflation or adverse economic conditions or just the day-to-day competition of running a business, that's not going to cause your company to cut that dividend. Financial condition is huge. So we want companies that are in strong financial position. That often allows them to continue to pay a dividend. Companies that get in very poor financial shape may have to direct their funds in different places. They may have to pay off debt, try to get their debt levels down. They may be prevented from paying a dividend because they have broken some sort of bank covenant that governs when a company can pay a dividend or not. We'll talk about that a little bit with hybrids in a second. Recurring revenue. Anytime we're looking to buy a business, we like recurring revenue. So when we're talking about recurring revenue, it's the difference between a company that literally has to go out there and fight for every single sale, right? And what that is a very transactional business, right? That you are literally out there trying to convince a customer, maybe the same customers over and over and over again to purchase from you, versus recurring revenue. And that's revenue that is either very sticky because people are kind of on these year-to-year contracts that keep rolling over. It's very difficult to pull out of them. Even people out there use Spotify or Netflix or everything else in the past. Some stuff has happened recently with inflation. They've had a lot of recurring revenue because it's not that much. It just gets charged on your card. You don't ever really bother canceling. So that's really what we're looking for, software licenses, things like that, because obviously that means you're not going to see these huge swings in earnings, which means, of course, the dividend's more sustainable. Margin. So margin, the difference between revenue, so the top line, what some company sells goods and services for, and then the bottom line, how much they make or how much they keep out of what they've sold. We want high margin. High margin can indicate that a company has a sustainable competitive advantage. High margin is obviously good because I get to keep more of every sale I make. So we really want to guard against margin compression. Companies where we're seeing that margin go down, that could be an indication that they might have to cut their dividend. And then the dividend payout ratio. So I talked about this a little before when I was looking at Australia. versus other countries, and that the payout rate is much higher in Australia. So companies are paying out more of their dividends now, more of their earnings and dividends. Now, that can be a good thing because you're getting higher yields. It can be a bad thing because it means any sort of earnings fluctuation could cause that dividend to be cut. So a simple example is that if I'm paying out 50%, an exaggerated example, if I'm paying 50% of my earnings out as dividends, well, earnings have to drop a lot before I'm forced to cut them. If I'm paying 99% of my earnings out as dividends, very small fluctuations in my earnings could impact my ability to pay a dividend. So the lower the payout rate, generally the safer we think that dividend is. And often that's something you can look at when we're making that trade-off between really high current yields and trying to avoid those companies that will cut dividends. And then, of course, companies that have a more sustainable dividend they can maintain in the future and hopefully grow as well. All right, so here's the slide that lots of Australian investors will roll their eyes at, but it's a point about diversification. So what I've done is I've taken top 10 holdings in the ASX, so the 10 biggest companies in Australia. I invested in all of these equally. So this is an equal weight investment in each one of these. You can see that I bought $1,000 worth of every single one of these companies. Look at the dividend yield. So this was about 2 weeks ago. Could have changed a little bit. The point still makes sense. I looked at the dividend yield, how many shares I bought, and what my income was. So the good news is that if you did this and you went out there and put $10,000, $1,000 in each of the top 10 companies, you're getting a pretty good yield, right? 5.10%. Plus, a lot of these companies are fully franked as well, so that will benefit you. So I'm making $510 in income, of course, on that yield. So pretty good. But if we start to go through here and look at the list of companies that are on here, particularly the very high dividend payers, some things are going to start to jump out at you, which is unsurprising for anyone who follows the market. First thing is we've got a lot of banks in here. We've got CBA, we've got NAB, we've got Westpac, we've got ANZ, we've got Macquarie. Right, so you start adding up these numbers, your percentage of income on all of those starts getting quite high. So you're very exposed to the banks. Then we can start sitting here looking at some of the miners on here, namely BHP. All right, BHP makes up a huge part of the market locally. You're getting 15% of your income just from BHP. That's a lot. And so what we notice about Australia very simply is you're obviously getting a lot of your income. So not only are these the biggest companies in Australia, you're also getting a lot of your income if you're an income investor. And this isn't necessarily the case in other markets. So you'll find, like if you look at the US market, for example, what are some of the top companies? Apple pays a dividend, isn't that big. Microsoft pays a dividend, isn't that big. You start going through those lists, I guess Facebook or Meta has dropped off. Google's still up there. Neither of those companies pay dividends. But in Australia, you're getting a lot of concentration in certain industries. And that, once again, can be a problem. And it can be a problem if you're trying to create an overall portfolio and a sustainable income stream. Now, I know this is where everyone's going to say, what about the franking credits? Yes, you don't get your franking credits if you invest overseas because they don't exist. But remember, you are able to diversify into different sectors. You're able to diversify, into different economies, and that does have a benefit for you. So when we're thinking about diversification in an income portfolio, don't just look at the position size, because in this case, very simply, the position size is all the same, right? I put the same amount, 10% of my portfolio in each one of these companies. We start looking at income, we can start seeing that there are really big differences. So CSL, for example, third largest company in Australia, CSL pays a very low dividend. So only 2.2% of your income is coming there. But then we start getting into Woodside, 19.5%, BHP, 15.6%. getting a lot of your dividend income from a couple different sources. So remember, we want to diversify not just by position size, but we want to diversify from an income perspective, because the reason that we invest and the reason we diversify is we're trying to eliminate that single company risk, right? That if something happens to a single company, something happens to a single sector, it's not going to bring down our portfolio and prevent us from achieving our strategy. And if you look at this, 19.5% of your income coming from one share in this case, well, that's not diversified, right? That is a lot. A dividend goes away, you might be in trouble, especially if you're using that income stream to pay for something in life. I wouldn't be too happy if somebody came and cut my salary by 20% tomorrow. So yes, that is important. All right, we'll go through the instruments, and we'll get to a couple other questions, and then we'll finish up the last couple slides. There are a lot of different ways you can access income, but it's important to understand the considerations for each one of those. So we'll start with shares. So very simply, this is you going out and making a direct equity investment. You're going to buy CDA, for example. So one very, very, very important thing to look at, obviously, as we've talked about, is sustainability. So remember, dividends are not guaranteed. So when you're going in there, don't just go out and buy the shares. I've said 15 times during this, the highest yield. Focus on that sustainability. Just remember that dividend is not a guarantee. Every one of the yields you're looking at is looking into the past, what the company has paid in the past. If you're buying equity ETFs and funds, so funds and ETFs that hold shares in them, there's an important thing to understand about that vehicle that the shares are being held in, and that is that ETFs and funds are what we call a pass-through vehicle. So very simply, what that means is that any income that they receive, any capital gains that they receive, they have to, it's not immediate, but they have to, within the next time they pay a distribution, pass all of that out to you. Now, I said distribution for a reason, because funds and ETFs do not pay dividends. They pay distributions. Distributions involve both capital gains and dividends. So it's important to remember that. So they're automatically passing that through to you. And it's important to remember that there's two different components, because the fact that there are two different components means you can see more volatility. So if you're going back there and you're looking at an ETF or you're looking at a fund and you're trying to judge it by what it paid in the past, remember that could have come from capital gains. Capital gains are not necessarily going to be replicated in the future. Just be careful about that. And really the way that you can do that is go look at what are the conditions that fund or ETF has before they will sell securities, because selling that security could potentially generate a capital gain. It will generate a capital gain if it's appreciated in price. So with active ETFs, of course, they get generated because a manager is making that decision, active ETFs and funds. But with a lot of passive ETFs, even if they're tracking an index, some of these indexes have very high turnover sort of built into them. They have rebalancing, or basically rebalancing is the big one. So just go back and explore that, because once again, you could get into a yield trap where you're going to go out there and buy an ETF because it paid a big distribution. Then you realize that that distribution was actually capital gains and it wasn't dividends, because that capital gain could disappear in the future. So something important to look at. LICs. So, and particularly equity LICs, although this is true of all LICs. LICs are not pass-through vehicles. So a LIC, because what does the C stand for? It's a corporation, right? So, company, same difference. They are not required to pay out all their dividends and capital gains. So the manager of that LIC actually gets to make the decision. And many investors who are looking for income like to invest in LICs. They like to invest in LICs because sometimes LICs can be trading at a big discount to the net asset value of the assets in it, which means the yield is higher. They like to invest in LICs because the LICs have this income smoothing capability. So what a lot of LICs will do, go back and look at the history of them. What a lot of them will do is they'll almost have this rainy day fund, and they use it to smooth out those dividend payments, those distributions that you receive as an investor. So you could have, and going back and looking at COVID is the perfect example, that there's much less volatility in the dividends from a LIC than the underlying companies. And that's because they had this reserve, so they could keep that income up. And so they know that's why people like investing in LICs. They like them because of income, and they respond to that investor desire. That's why they build up those reserves. So something important to remember. Bonds pretty easy. If you go out and buy an individual bond, so long as the company or country does not default, you know exactly what you're going to get, that yield at cost, right? You go out and buy a bond at 5% yield, you will get that until the bond matures, as long as they don't default. So that's pretty easy. But remember, inflation is a real challenge with bonds. So you, of course, have a fixed amount that will be paid out to you. Inflation goes up, those cash flows are worth less. So particularly during this time, something to remember with bonds, bond ETFs and funds. So bond ETFs and funds, they throw a lot of data at you. And some of it's very complex because they're looking at a lot of different, and it's all good data. But what you really want to look at for all of those is you want to look at running yields. So running yield is an indicator of what income you will get based on you buying that right now. Because remember, these portfolios are always changing. They're always getting new bonds added to it. There's always shifts in price of those underlying bonds. So really running yield is an indication, at least in the short term, what you are going to get from that investment. But the other important thing to remember about a bond or an ETF, or a bond ETF or fund, the other important thing to remember is the composition of that portfolio will change over time. So if you go and look right now, remember we had very low interest rates just a couple of years ago. Now they're higher. Even an index is constantly adding new bonds as different bonds mature. And so in a rising interest rate environment, that yield on that portfolio will go up over time, right? So if you had a intermediate term bond fund a couple of years ago was buying bonds that are still held in that portfolio that were paying next to nothing. Now you're actually getting a decent payout on them. So just remember over time, that yield's going to change. So there's unpredictability around that future income that you're going to get because that portfolio will change. So something to think about. Hybrids have been in the news a lot lately. So hybrids is security that has debt and equity-like features. People like hybrids. Retail, everyday investors like hybrids. They like them because they generally have high payouts in terms of the income they generate, and you get franking credits. So people are very into franking credits, as they should be. They can help a lot. Just remember that, and the other protection that you have in hybrids is generally, we talked about covenants before. So most companies cannot pay a dividend on their regular common stock if they are having problems, they can't pay off that hybrid. So if you own a CBA hybrid, you know the first thing that's going to happen is CBA is going to cut their dividend to zero before they can even touch what's getting paid out to you. So people do like that. Just remember that those two events could happen at once. They could cut their common dividend and their hybrid payment if the bank got in a lot of trouble. And the reason hybrids have been in the news a lot is what happened over in Switzerland, where regulators basically wiped out all the hybrid holders before impacting some of the common equity holders, which I've been told in every article I read that that cannot happen legally in Australia. But yeah, something to look out for. My former colleague, Emma Rappaport, wrote an article on hybrids in the AFR the other day, which was pretty interesting. They kind of said that. But remember, hybrids are complicated. Hybrids can convert into common equity, and those conversion provisions are unique to each hybrid issuance. So they can be pretty complicated. So just something to think about. All right, so let's get to some questions before we go through the last couple slides. So David is saying, where can we find rankings of ASX dividend payers, dividend growers? Yeah, so I think you're probably looking at two things. So dividend payers, most companies actually pay pay dividends in Australia. So that's one thing I would say. In terms of looking for those, I can certainly send you a list of dividend payers if you email me. But really, you can Google companies with highest yields in the ASX. In terms of growers, that data is a lot harder to find. So really, that chart I put together on the S&P 500, for example, that's because I couldn't find the data in Australia. So that data is a little harder to find, but I think it's really going back, and you can look at individual shares and see what if that dividend's grown. So that's something we have on our website underneath each of the individual shares. You can go in the dividend tab and then look at that history. All right, volatility, dividend cutters. Should I sell Fortescue and AGL? I, of course, cannot tell you if you should sell or buy anything. What I would say is one of the downsides in Australia with very high payout rate is that the volatility of dividends typically is higher than it would be in a country with lower payout rates. And we can see that with some of the miners. The miners have paid out huge amounts of dividends in the last couple of years because, of course, a lot of the commodity prices have been very high. Now, I think most people do not expect them to maintain those dividends, but that's an example where you can see volatility between dividends every single year. So, yeah, be careful of that. And really, that's where we want to look at the overall company and look at, hey, are they benefiting from something like sky high commodity prices that are not expected to last in the future? I think certainly our analysts have said yes, they are. But that's really where you need to look at that volatility once again when you're trying to figure out stability. Is this share portfolio your ASX share game? I've never actually entered that, Lisa, right? Because I'm embarrassed that I would lose. So June says the other thing that throws a spanner in the works of your portfolio are takeovers. They are not always accretive or positive for the portfolio owner. Yeah, one of the challenges you get into, and I frankly, I've had this frustration with some of the Australian shares I've owned lately, is there are takeovers which are great. Generally, you do get a higher price, but if you're out there looking for yield, that can be very frustrating. And it can be frustrating if it's a position that you really like, you really think it's going to do well. And then, of course, some private equity firm thinks it's going to do well too, and they come buy it out. And they don't necessarily capture a lot of that upside. So we're seeing that recently with InvoCare, right? So InvoCare, private equity firm tried to buy it out. They said the price isn't good enough, and we'll see where they land there. And our analysts certainly don't think the price is good enough either. But yeah, no, that's something that we've seen. Okay, so we've got a question from George. How about ETFs linked to particular commodities? He's listing a bunch of them on here. They do pay distributions from capital gains and income. Please comment. Okay, so be careful about what that commodity is, number one, and how they get that money from it. So very simply, if you have a lot of these commodity-linked ETFs are linked by using derivatives. So they are using like forward or future markets as ways to try to capture the price change of that underlying commodity. And the problem that you run into there is, remember what you're buying, right? You're not buying anything, right? You are buying a future. Futures pay no income. The problem with these futures markets when they do it, so let's take oil for example. If you're going out there and you're buying something that's connected to the price of oil, futures contracts are basically pricing out, I'll try to make this a short explanation, but what they're basically doing is they are pricing out delivery of that commodity in the future, right? And people use that for hedging. But an ETF that's using that is very simply saying, okay, well, there's a futures contract for oil delivery in 3 months, and that futures contract is going to be impacted by the change in price of oil. But guess what? The ETF has no oil. So they can't deliver oil in 3 months. So what do? They sell that futures contract as it approaches the expiration date, and they just buy another one. So they're rolling these futures. So you are getting no income from that. You are getting capital gains. getting capital gains if we are seeing those futures continue to go up over the course of that holding period they have. So let's say it's 3 months, and it's these ridiculous terms that come up in finance. It's basically, what is the shape of that futures curve? So what is its backwardation is one of the terms, and contango is the other one. Send me an email and I can write out more of a description of this. But remember, you're getting no income from that. Those are all capital gains being generated by those dividends. And George is saying that. Sorry, something to add. Last year, Triple O paid enormous distributions, so like 20-25%. That's when you bought. How did they do that? Yeah, they are not trading that underlying commodity. We saw very, very strange things happen last year with a lot of these futures contracts on commodities because of everything that was happening. We had inflation, we had the war in the Ukraine, and what it did is it changed the way that a lot of these futures were priced, and it benefited you in terms of distributions, but that is not sustainable. You absolutely will not get that under any sort of normal market conditions. So I can promise you that, George, but I wrote out a longer explanation to that. So if you have a question, more questions on that, shoot at it. Yep, George said, look at the second part. Sorry, I can only read one thing at once. So a couple questions about hybrids. Lisa's saying the price of local hybrids in the market dropped a lot last few days. I thought it was a good time to top up quantity. Yeah. So, in terms of hybrids, it's really that Credit Suisse thing, and basically people getting very worried about that. We've got Barry saying hybrids becoming less available to retail investors. Any comment? Yeah, the only comment that I would have is hybrids are largely bought by retail investors. There are some concerns that they are too complicated for people to understand. Now, legally, the way they're doing this is kind of stupid. What they're not letting you do is they're not letting you buy hybrids at issuance. You can just buy them the next day, right, once they're trading. I would say that, yes, they are probably more complicated than people give them credit for. So something to consider. Just make sure you understand it. We do have research reports on hybrids as part of Morningstar Investor. So if you don't know where that is, let me know and I can send you a link to it. But yeah, you can read a little more about the hybrids, but a lot of the terms in hybrids are very unique. And if something happens, that is when that fine print, those terms really impact you. My lights went out behind me. All right, let's talk very quickly, and I know I'm over time, so feel free to go do something better with your night. But let's talk about sources of income growth, because this is important. This is the last slide. But there are 3 places, if you're thinking about dividend growth and you're trying to grow that passive income stream, there are really 3 different places that you can get that. Earnings growth. You still need to assess the company, because if they're not growing earnings, they are probably not going to grow dividends. But remember, management intent is really important. A dividend is a choice. Dividend policies are set by management. One really good thing, I think, in Australia is a lot of companies will set a payout rate that they are targeting. And you'll see that. Go in and the company will say it. It's in our analyst report, but the company will say it. It's in their management presentations. If you go to their investor relations website, they'll say something to the effect of, we will pay out 70 to 75% of our earnings as dividends. And that's where you can start seeing, we're talking about a lot of these mining companies, we can start seeing, okay, well, if their earnings go down, their dividends going down because it's a set policy. But remember that management intent part is really important. Those 2 things equal dividend growth. Compounding. Reinvesting that money, whether you do that through a dividend reinvestment plan directly, or whether you're just taking those dividends in cash and reinvesting them. Remember, you'll get that compounding effect where you are earning income on the income you generate, and that builds over time. So remember, compounding is really important. And of course, new contributions to portfolios. So if you're adding new money to your portfolio, of course, that is going to matter as well. And that's really going to help you grow that income stream. So we made it to the end, which is good. Okay, June's saying that's not strictly true about buying hybrids if you become a sophisticated investor. So yeah, to be a sophisticated investor, you don't have to pass a test. You just have to have a certain income or money. So that's or a certain level of assets. So yes, you pass that sophisticated investor, wholesale investor test, then that is true. But anyway, thank you guys very much for joining. So I'll be off next week. No webinars. I'm going to Thailand, which is nice for me. But we'll be back in April, and we'll do some international investing webinars. So thank you guys for joining. Shoot me an email if you have any questions.
This video has been prepared for clients of Morningstar Australasia Proprietary Limited and or New Zealand wholesale clients of Morningstar Research Limited. Any general advice has been provided without reference to your financial objectives, situation, or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest. To obtain advice for your own situation, contact a financial advisor.